presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for December 17, 2021. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. You can get the daily edition of Market Wrap simply by going to marketwrapwithmo.com, and there's a link there that you can download, and it will give you the daily update. The daily broadcast that I do, 1 hour broadcast, we have some great guests there. You can download it to your iPhone or to your iPhone or to your Android phone and get the daily update. It'll be downloaded absolutely free. So it is a free Market Wrap update that you can get on a daily basis. Let's talk about the December, all December end of portfolio review. We're going to do a year-end review. We are going to schedule that before the end of the year, where I'll look back what happened this year and what to expect next year. So make sure you subscribe to the daily updates and this YouTube update. Let's look at COVID. Omicron is the one that is starting to impact the markets, I think, a little bit. I don't think, as I mentioned on the daily broadcast, that the markets are going to be impacted, or at least the governments are not going to shut down, especially here in the United States. I think politically it is not feasible to do so. We are seeing some restrictions being placed in Europe. France today announced that they are going to stop people from Britain coming over. The cases in Britain are exploding, and so are the cases here. We had 120,000 cases of COVID, and it was up a 40% increase over the last couple of weeks. So we are seeing COVID, the Omicron, starting to expand and get, but I think people are now getting used to living with COVID. As I mentioned a year ago, that this is going to be an endemic, not a pandemic, something that we'll have to learn to live with, and something that it's going to be like the yearly flu. Everybody is going to sooner or later, unfortunately, get it. But if you have been vaccinated, you have been boosted, the probability of you having a bad outcome is small. So I think people are getting, more and more people are going towards getting vaccinated. And unfortunately, in the short term, we've got to go through this small surge. I don't think it's going to be as bad as Delta, but who knows? We are getting to the point where it's starting to really spread. Looking at the numbers, jobless claims in the 2019 level pre-COVID, we are below that. So the jobless numbers, initial jobless claims, are one of the lowest levels. Jobless claims, we're still a little bit higher, about 7% higher than where we were, but there's plenty of jobs out there. If anybody who wants a job at this point can go get a job. We're looking at most of these numbers higher. Box office receipts, we're still not used to going back to the theater, but we're gradually getting back. I think we've gotten so used to Netflix and Prime Video and all of these other streaming services that people have sort of given up on that. And it'll take, I believe, a lot longer. Even when COVID is something that we've learned to live with, I think it'll take a lot longer to get back to the theaters. Rail car traffic is just about where it was pre-COVID. We're looking at steel production, we're there. We're looking at hotel occupancy, just about there. We are still seeing TSA. Travel is still something that is not, it's still 15-16% below where we were with COVID, and that is because of international travel. That has still not come back. Global, when you look at global travel, you're looking at 18.2% lower, and I think that is a case that we're still, the world is not fully vaccinated, and it'll take some time. Looking at the numbers, we closed lower amid interest rate worries and COVID. I think what the Fed did was on Wednesday, when the Fed announced that they're going to have 3 interest rate increases and double the taper, that means increase the amount less bond buying that they're going to do. They're going to buy 30 billion less instead of 15 billion, which they had said previously. But the more important thing, they said they'll be done with the taper by March, and the probability of 3 interest rate increases, March, June, and later on in the fall, depending on market conditions and economic conditions. But seems like the Fed is stepping on the brakes a little bit harder. It's a very delicate balancing act. They want to step on the brakes, control inflation, but at the same time, they don't want to put us into a recession. Will they step too hard, put us into a recession, or not enough, and inflation continues to go up? That is going to be the delicate balancing act. I believe inflation is going to start coming down, but there are certain aspects of inflation, like shelter, which is rents, which is a very big part of the CPI. That has not gone up because we had eviction moratoriums, we had rent forgiveness, and all of that sort of thing. But all those supports, COVID supports, are starting to fall off. So rents could go up, and that could bring up some of the CPI numbers. But on the other hand, we are starting to see supply chain congestion, which was due to we didn't have enough truckers. We had 800,000 truckers going into COVID. That fell to about 730,000, and demand all of a sudden spiked. But now we're starting to see the demand and the truckers' numbers catch up a little bit. That's what happened to just about every business. Every business laid off people. All of a sudden, we saw the surge in demand, and that really caused the bottlenecks that we're seeing. We did see freight containers, which were about $1,000 a container, go up to about $21,000, and now they're starting to come back down. Same thing with on the East Coast, where they're about $3,000 a container. Now it's down to about $17,000 down here. So we're starting to see the congestion ease as we untangle the supply chain, but I believe it'll take another 3 to 6 months. But we will see this huge supply going to hit. And what happens to demand if you see Omicron start to impact the economy, people going out less? I think that is going to cut back demand a little bit. Supply is going to catch up, and it could see prices coming back down. We are still seeing the increased delivery times. It was about 40 days. Now we're double that, about 70 days or greater. And that's what we're seeing. But I think we are in the process of unwinding or untangling the supply chain issues. This was the initial tapering that was expected, 15 billion. They'll be done by June, but now they've changed it to 30 billion. They'll be done by March. And this interest rate increase is moving, going towards March. And instead of 2 interest rate increases, we could get 3, one here, and one here. So that means rates could be going up to about 1%, or somewhere around there between the Fed fund rate. That's what they're expected. It is at 0 now. They expect 3 25 basis point or 0.25% increases next year now. How will the market react to it? That's the question so many of you are asking. I believe that the market is ready to handle that. If you look at probabilities, that it was about 50%. Now we're up to about 75% on these probabilities that we'll see interest rate increases. Where does it start to impact the market? Historically, if you look at 1965 to 2009 data, when the 10-year interest rate, which is about 1.4 today as of today's close, goes up above 4%, is when we've seen negative outcomes in the stock market. But since 2009, we've got so much more debt. I believe that threshold is going to come down. That means that when is the higher interest rates going to start the economy and start hurting the stock market? If you look at it, we're looking at somewhere around 3.5% or so that it starts to impact the stock market. I believe it could be somewhere around 3% when the Fed fund rate goes from 1.4% where we are today to 3%. That's where we start seeing a problem. Initially, when the rates are going up, they're going up. Why? Because the economy is too hot. It's doing too well. There's too much demand. That's what we're seeing. So the economy will continue to do well, but there are some stocks that are going to get hurt with higher interest rates, especially the growth stocks. You've got to discount the growth because it is worth less with higher interest rates, and that's why we've seen the tech market down about 4% this year, or 4% this week. So we saw a much larger decline there. Looking at interest rates, when are they going to start impacting? You see the 2-year note starting to have a negative impact. If you only have 2 years, interest rates go up by 1%, you lose about 1.4%. If interest rates go up 1%, if you have a 30-year bond, you lose about 18%. So you can see that if you have a long bond portfolio, that could be impacted by this. I think as the bond portfolio, if you have a shorter duration portfolio, it will not get impacted as much. When interest rates start to go up, stock market goes up 82% of the time, rates down, stock market goes up 75, baseline 77. So when rates initially start to take off, the stock market does well. But there is more volatility. That's what we're seeing now. I think this volatility will continue into next year. That's why you have to have the correct balance in your portfolio. Areas that do well, obviously commodity-based, and companies that have real assets do well in inflationary times. We are seeing vacancy rates still going up for commercial properties, but you're seeing vacancy rates for apartments coming down. You're seeing rentals, vacancy rates, retail going up. So, and you're looking office space going up. Industrials, they're at one of the lowest levels. So we're seeing different parts of the real estate market being pushed around. I still feel that rents could be something to watch next year. I believe, as I've said, that we have pulled forward appreciation in real estate from the next couple of years to the past couple of years, or the last year and a half or so. I think the real estate market, as interest rates go up, prices have already gone up. People were able to buy these higher priced homes because the payments were so low with interest rates so low. With the rates going up, I feel that the payments are going to be a problem, affordability is going to be, and we could see some softening in the real estate market. I don't see a crash, but I think we could see some softening. The initial surge, I showed you this chart previously, where the saving rates had gone up to about 35%. Well, I said that in the fall, as we go out, kids go out, we catch up with all the spending, we're coming back down to about the same 7-8% rate. So we've used up all of that surplus cash or savings. We've used a lot of that. Don't forget to subscribe to this. Simply click on the button right there. Whenever you get a notification, whenever I place an update, you will be notified that there's a new update. Looking at the charts, here's the 10-year Treasury. Interest rates should be going up. They got above the 200-day moving average, and now they've fallen back down. I would not want to see the rates get much below 1.25. If they start going much below that, below this level, that could be a problem for the stock market. What it will show that people are buying bonds for safety, and they're not really worried about inflation. They're worried about the slowdown in the economy. As the economy slows down, it'll take care of inflation by itself because demand will go down. So I would watch the 10-year carefully. I still think that it could get to about 2% in the long term. Maybe in the middle of next year, we could see that. The S&P came today, kissed the 50-day moving average, managed to close back above it at 4620, got below 4604, got to about 4600 as a low today. So it is still holding the 50-day. If it breaks below the 50-day, we could see a retest of this number right here, about 4,500. That's what we're looking at. But this is still a fourth wave. And as I mentioned, fourth waves are messy. They'll go back and forth before we break out. If we can break out above this all-time high of 45.43, that's the all-time intraday high, not the closing high. If we can get above that, I think that will clear us towards the 48.80 target that I have. Will that happen? We'll have to wait and see how Omicron does, which is something that is a wild card right now. I think the market will figure out that the Fed interest rate increases are not going to impact some of the value stocks, some of the good companies. Some of the companies that don't have earnings could be in trouble as interest rates go up. So you have to do the fundamental work, make sure you have the correct fundamentals. The companies have cash flow, they have earnings, and they have the probability of continuing those earnings going even with higher interest rates. On the weekly charts, where each one of these bars is 1 week of trading, this goes back to about 2018, 2019, 2020. This is COVID when it struck, and since then we've been in the third wave, which is the longest. When are we going to start a weekly fourth wave? If we get much below 4,500, that'll start to get me worried that we could go down all the way down to 42.5 or maybe 4,300, and that would constitute a weekly fourth wave. I don't really expect that until we complete the 5 waves on the daily charts before we start seeing a fourth wave pullback on the weeklies. That I think will happen somewhere next year at the beginning of, in the first quarter or the second quarter of next year, as the market starts to grapple with higher interest rates. Same thing with the Nasdaq. We are below the 50-day now. We're getting close to this 14,950 low that we made at the beginning of last month, and that's beginning of this month. If we break much below that, then I would not be surprised to see 14.5, which is the 200-day moving average on the Nasdaq. Because Nasdaq are tech stocks, they're growth stocks. Their growth will be discounted more as interest rates go up. The value stocks are the place that we are going to do well. The reopening small caps are the reopening trade, and we'll talk about that. We're sitting at the 20-week moving average right now on the Nasdaq. Again, if we break that, we could come all the way down to the 14,000 level on the weekly charts. Gold had a good week. It was above, got above the 200-day and the 50-day moving average. But with interest rates going up, gold has an uphill battle right now. With interest rates, when they go up, the dollar goes up, and that has a negative impact on the gold market. Critical support is still around the 1720 area, and that's these bottoms right here. If we break those, then we go down to the triple bottom that we have this year, which is around 1665 or so. But if we break that, that would be a major blow to the gold market. Crude oil stuck between Omicron and the demand picture right now. We think that demand is going to remain constant. OPEC has left open the possibility that they might not add 400,000 barrels to their production number. They've left their OPEC meeting, as they call, open. So they're looking at supply and demand. Also, I think OPEC will step in if we get much below the $60 mark or $62 mark that we made at the beginning of this month. We're right at the 200-day moving average right now at $70. We closed at 70.13 today. So we are right about that $70 mark. I think crude oil is going to trade between 75 and 65 for the foreseeable future. The small cap, we got above the 2400, these highs that we had made, 2380, got up to here. Then we fell right back down as we saw Omicron start to come into the picture. I call this the reopening trade. The small caps, they are more impacted by COVID than the large caps, because large caps have a global footprint and they've got more technology. So this is the reopening. We have 2100 as a critical support. These are the lows that I would be looking at. We've come back here a number of times and managed to hold up. So we are right at that 2150. As long as we hold 2100, I think we're still okay with the small caps. That is my view. Those are my opinions. That's the way I'm looking at the markets today. I hope you have a wonderful, wonderful weekend. Don't forget, I will do a year-end portfolio review. If you would like us to do that, just go to compak.com, compak.com, and request a free review. We'll do that for you. We'll find your risk number. We'll find a matching portfolio. We'll show that to you and show you how you should be invested at your age with your risk profile, and give you a sort of a roadmap to how to get started in creating wealth. I'm Mo Ansari. You can schedule a sit down with us anytime. Those are my updates. Those are my thoughts. Have a great weekend. I'll be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors, because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.